Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 195 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you into our world of financial markets and financial planning. So good morning, Matt.
Morning, Mark.
Best week of the year, in my opinion, Masters Week.
You're dressed for it, baby.
I'm dressed for it. Got my green golf shirt on, green pullover, and
socks.
Then my Happy Gilmore inspired socks.
For our YouTube
Adam
viewers
Sandler,
can take a good look at those bad boys.
telling the ball to go in its hole, so I'm ready.
They just teed off. The first group was what, 8 a.m.?
Yeah, right around 8 a.m. So they're about an hour underway. So should be an interesting one. Forecast is a little spotty. Supposed to be thunderstorms on Friday, Saturday, Sunday. So we'll see if it's a Monday or possibly even Tuesday finish, depending on the weather.
Do you feel comfortable maybe naming some of your favorites for this weekend? Just a
Yeah,
couple?
I'll name a couple. I think Jordan Spieth, he's won the previous 3 Easter weekends, last 3 years. So, and he's playing really well right now. He's won at Augusta before. Rory McIlroy to finish the major Grand Slam has to win the Masters, and he's arguably playing the best golf he's played in the past 5 years. So he's won the U.S. Open, the British Open, and the PGA Championship. So he just needs the Masters to join the elite group of winning all 4 majors.
Interesting.
And then I think it's hard to bet against Scottie Scheffler, the number 1 person in the world right now, and he's just on fire this year.
He seems to be.
Yeah, so should be interesting.
Can't wait to watch on Sunday.
Should be very interesting. Yeah, me too. But before we begin, as always, getting back to our agenda, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track, and these numbers are as of the market close on April 5th. As always, this data is from Y-Charts. S&P 500 index down 0.5% for the month and up 6.5% for the year. The Dow Jones Industrial Average up 0.6% for the month and up 1% for the year. NASDAQ Composite Index down 1.8% for the month and up 14.6% for the year. The Russell 2000 Index, small cap index, is down 2.7% for the month and down 0.4% for the year. And the Vanguard All World Ex United States ETF flat for the month and up 6.7% for the year. 3-month Treasury rate at 4.86%, the 2-year Treasury rate 3.79%, and the 10-year Treasury rate 3.3%. Moving on to big headlines, current events from the week. The BRICS, countries.
It's been a long week.
Brain fart there for a second.
It's all right.
The BRICS countries are working on a new currency, it seems like, Matt. So for those who don't know what that is, BRIC stands for Brazil, Russia, India, and China primarily. And they plan to discuss details in August during their annual BRIC summit in South Africa. So, I don't think this is a major story yet, but it's been talked about for quite some time that the dollar is no longer eventually going to be the reserve currency in the world. And I know it doesn't really apply to these countries because they're kind of on their own and at ends with the rest of the world in terms of allies and all that stuff. But anything else to make of this?
When I saw this post, I saw someone put a cover page of The Economist magazine from 2004 that was predicting that the dollar would no longer be the world's reserve currency in the near future.
So this isn't the first time it happened.
And that was 19 years ago.
Right.
So I think this is an ongoing theme. Does it surprise me that countries are going to try to come together and have, say, an alternative? Possibly. But let's just face reality. At the end of the day, the dollar, in my opinion, is not going anywhere anytime soon. Could it diminish in its role, say, the next 50 to 100 years? Absolutely, it could. Mm-hmm. But this is not going to be something that happens in a couple of years.
Yeah, no, I agree with you there. Next big headline was OPEC announced production cuts on Sunday in a move to get oil prices higher after some recent weakness. So, for those that, might not know about OPEC and how gas prices work in oil, production cuts reduces the supply of oil, which increases the price, vice versa. They release more oil, price goes down because there's more supply. But this hasn't really been surprising to me, Matt, just because typically we see leading up to the summer months, or as we approach the summer months, gas tends to increase a little bit just because the demand's higher, right?
Seasonality, baby.
So that's just something to keep an eye on. Moving on to tweets, articles, and research from this week. The first thing I had was a tweet from Car Dealership Guy on March 28th. And he said, finally, some positive news for car buyers. New car inventories are up 50% year over year. Buyer incentives are up 50% quarter over quarter, and markups are slowly disappearing. And he said only in certain brands. He said the tides are slowly turning. So for anyone out there that's looking to buy a car, new or used, within the next several months, definitely keep your eye out because those prices are finally starting to come in.
The old classic supply and demand metrics are coming back into play finally.
Right. Yeah. And it wasn't that long ago where it felt like, car prices were going to stay elevated forever. Right.
Yeah. That. And you drive by these, car dealerships and there'd be like nothing on the lot.
Right.
There was nothing there.
Right.
You are starting to see just visually more inventory too.
Yeah. So just wanted to point that out for people possibly in the car market.
There you go.
Second thing I had was a blog post from Ben Carlson on March 28th. And this was titled, Why the Stock Market Makes You Feel Bad All the Time. So just a few points I want to read from this. He says, the last new all-time high for the S&P 500 was on January 3rd of 2022. That means it's been almost 450 days since we've experienced new highs in the stock market. That feels like a long time, but based on the history of markets, it's really not that long. It might be a while until we hit new highs again if we use history as a guide. I looked at every bear market going back to 1950 to see how long it has taken for the markets to reach a new all-time high from the previous peak.
This should be good.
If we include the current bear market, the average peak to trough drawdown is a loss of a little less than 35%. That's the average.
So call it what it is, a third, right?
Right. Call it a third. The average number of days to go from peak to trough is 381 days, so just over a year.
Okay.
The average number of days to go from the previous peak to the new all-time high is 1,166 days, or more than 3 years. The shortest round trip from peak to peak was the COVID crash in March of 2020. We saw new highs in 6 months. Before that slingshot of a bear market, the shortest amount of time to see new highs again was 436 days in 1950. And again, when we say drawdown, we mean the previous peak until there's a new high reached, right? That's a underwater or drawdown.
Yeah, I was
right?
going to use that term. I always like talking about high water mark.
Yeah.
Right.
So it can take time to fully recover from a bear market. I don't know how long this one will take, but it's not out of the ordinary for the stock market to make you feel terrible on a regular basis. So again, it's just a different time than what we've been used to for the previous decade, where markets were making all-time highs each and every year, and that's obviously transitioned and hasn't happened in quite some time. But I think the opposite side of the coin here, which we talk about a lot, is the market's not making an all-time high, and as Ben said, if we use history as our guide, it will at some point in the future. So if you've been waiting for a buy point, in addition to everything else we discussed this year with the data that indicates to us that it's going to be a decent year, or at least better than 2022,
Yep.
might not be a bad time to dip your toe if you've been waiting.
It's interesting to look at those guiding emotions and investing of fear and greed. Obviously, there's times, relatively speaking, if you have a multi-year time horizon where it's attractive entry point in general. However, it might not feel comfortable to do so.
Yeah.
Right? Mm-hmm. And, usually when it feels uncomfortable, if you have a long-term time horizon, tongue-in-cheek, it tends to be a good time.
Right. Exactly. Yeah. Well said. Last thing I had was a blog post from Christine Benz on March 22nd titled, Luxury Goods Don't Have to Be Brand Name. So this is going to kind of be our financial planning topic of the week, Matt. But
Okay.
She says really expensive bags seemed to be proliferating. If a bunch of 27-year-olds can afford them, then I certainly can, I rationalized. Friends, ever supportive, agreed. You've earned this, one said. You'll have it forever, another. When the time came for the splurge, however, I found myself dithering. While my heart was with a black Chanel quilted bag, the outlay was literally equivalent to a third of my salary in my first job. Buying it required an appointment downtown, and I felt nervous carrying it. That experience was a good illustration of something I already knew. My definition of luxury has changed over the past few decades. With plentiful funds to cover the purchase, and even without, my 30-year-old self wouldn't have blinked. She'd have gone with the Chanel and basked in the admiring looks. But as I've grown up and have more funds at my disposal, a funny thing has happened. I'm much less inclined to want or need to show what I have than was the case when I had much less. My luxury goods today are much more in the category of things that make me feel good inside rather than looking good on the outside. So she has luxury good number one for herself, putting money in its place. The biggest luxury of being financially well, I've realized, is making sure that money doesn't have an outsized influence in any of the major decisions I might make, and most of all, that doesn't cause stress. Luxury number two, not having a budget. And this one was really interesting to me. She said, not having a budget is another one of my luxury goods. For years, I was sheepish about not budgeting, or at least not budgeting in the conventional way that every single personal finance book recommended that people do. My husband and I tried sticking to a budget early on in our marriage when our finances were tighter and we were saving for a down payment on our first house. Rather than tracking each expense line item line by line, we set our monthly targets for saving and investing, then automated those contributions to our retirement accounts and taxable brokerage account.
Yep.
We set fairly easy targets at first and increased them as our incomes grew. Any funds left in our checking account were there to do as we pleased. So I just thought that was really interesting, and I encourage people to go to Morningstar and read the full blog post. But, you know, a while ago I talked about a book from Ramit Sethi that says, I'll teach you to be rich. And he talks about spending money on things that you love and things that you enjoy and not buying things just to quote unquote keep up with the Joneses, right? Mm-hmm. And, you know, as you age and as you have a family or you buy a new house, you have a new job, your income grows, you get married, your definition of luxury does change.
Sure.
So, you know, I just thought it was good that, you know, sometimes even if you feel like you should be buying a new car or buying a new handbag in Christine's example, you don't have to if it's not one of your things, right?
Yeah, I mean, you could take Rachel and I as an example. You know, right after we got married in 2009, I would say in the first 5 years of our marriage, I can remember like 4 key purchases of what would deem to be, you know, luxury handbags that I bought for her. Mm-hmm. After those 5 years, I have not purchased her any handbags.
Right.
Because what happened is when we got to the teens, like around 2014, 2015, the prices on that stuff skyrocketed. And I'm like, it's no longer even remotely cost effective. Mm-hmm. Like it was already a stretch, but the prices are just through the roof.
Right.
And if I look at like where my wife is at today, we have our household budget. I don't look at anything that she spends as long as she stays within that budget. And she could clearly afford whatever she wants in that space. And she's getting, you know, it seems to be handbags that are around $100, $150, not, you know, $2,000.
Right.
And it's just interesting to kind of look, and maybe that's an age thing. I don't know.
Well, yeah, and that's a great definition. I would say, just knowing you both really well, you know, a more luxury good for her would be you guys going on a weekend birding trip now.
That's right.
Instead of having
that's right. And that's what she
Chanel
values.
handbag.
That's
right?
what she values.
So it's just interesting to see how that stuff changes. And I've obviously had that, you know, in my personal life. And I think any, you know, young person just coming out of college, they're like, the goal is to make as much money as possible, you know, buy a McLaren or a Bugatti or something, have this huge house.
Yep.
And it's like, you know, I've been through that mindset change where it's like, you know, the stuff I value now is very, very different from what I valued even 3 or 4 years ago.
Well said.
So
well said.
Just interesting. Wanted to throw that out there.
A nice multi-purpose topic for you.
Yeah.
Financial planning topic of the week. Good piece.
So,
Well played.
Yeah, thank you. That was a good article. Really, really recommend people read the whole thing.
You ready for me?
Sure.
All right, my first piece is a post by Seth Golden, and he was referencing FundStrat research, and this was on April 2nd, Mark. For those that don't know, FundStrat research is led by a gentleman by the name of Tom Lee. I'm a Tom Lee fan. He used to be the head market strategist at JP Morgan, okay? And he had this post where he was quoting FundStrat, and I'm going to do the quote. The S&P 500 has now posted 2 consecutive quarters of gains, a pattern not seen in any bear market over the past 50 years. This solidifies our view that the October 12th, 2022 was the bear market low, and we are 6 months into a new bull market. It is the bears who are trapped. End quote. Now, Jenna will share this chart with our YouTube viewers. This will be available for our show notes for our traditional podcast listeners. Mark, for our newer listeners, will you remind them how they can access these show notes, please?
Yeah. So at any of our social media sites, at Jessup Wealth on Twitter, Jessup Wealth Management on Facebook and LinkedIn.
So what this chart's going to show from FundStrat is it goes back to 2006, and it shows the S&P 500 performance on a quarterly basis, Mark. And he was just illustrating, he being Tom Lee at FundStrat, was just illustrating, that in their opinion, they feel that this is a new bull market, that this is not what we would call a bear market rally, that is a rally within still a downtrend. We saw this downtrend in place for 4 quarters, all quarters, mainly in 2022, and that broke in the fourth quarter, right? Mm-hmm. So this is obviously one opinion. He's backing that up going back to 1950. You're our firm's chief investment officer. When you see this kind of data, what goes through your mind?
Yeah, I would tend to agree with this research. And again, the industry definition of a new bull market is 20% up from the lows, right?
Correct, sir.
The NASDAQ has already exceeded that. I don't know where we stand really on the S&P 500, but yep. I think, in my opinion, just to even simplify it even more, is a bull market is by definition higher highs and higher lows in price. So well said, by the way. Very simply, price moving from the lower left hand of the chart to the upper right hand of the chart. And obviously, like you alluded to, in 2022, it was the opposite. We had lower highs and lower lows, chart moving from the upper left to the bottom right, which is what we don't want to see.
Correct.
And at least for now, we do have higher highs and higher lows in place.
From that October low.
From the October low, at this very critical level of about 4,100 to 3,900 on the S&P 500. And if you tuned in and listened last week, me and Nick talked about how we've been in this just sideways trading range for about the last year, since May of 2022. Sure. So, and that's been all the way up to 4,200, and all the way low is 37, 3,800. And that's probably one of the most frustrating markets, I think, for investors and people that are allocating money, because you just get whipped around, right?
You get chopped around.
There's no really strong definition of a trend, and we're starting to see possibly that might break. And if it does, I think we're going to be off to the races. So, 2 consecutive quarters of gains is the start. So we'll just need to see some follow through, but this doesn't feel like a bear market rally, in my opinion.
Again, yeah, I love what you said there, and I think it's just a nice piece of anecdotal data that is indicating that, okay, that's in the positive column.
Right.
So this next piece, number 2, I think is going to be right down your alley. For our regular listeners, you were pointing out the seasonality of the 4-year presidential election cycle earlier in the year, Mark. Mm-hmm. Will you just take a second and explain to our listeners What is the 4-year presidential election cycle?
Yeah, so it's just looking through stock market returns through the lens of history with 4-year presidential terms, right? So, we chart out and do all the data on, what are the strongest parts of that 4-year cycle and what are the weakest parts of that 4-year cycle. And again, for new listeners, year 2 or the midterm year of the presidential cycle tends to be extremely weak relative to the other 3 years, right? And the interesting part is that year 3, or what we call the pre-election year, which is 2023 in our case, tends to, be the strongest part out of the 4-year presidential cycle. So again, that just is another data in our cap that I think things are going to be better than what they were in 2022.
Well, you're going to love this next piece I have, because this piece is from Carson Investment Research through our friend over there, Ryan Dietrich. What he did is he went back and he looked at those midterm election years, Mark, that were negative. And what he did is he looked at it and said, what were the returns in year 3 after a negative year in the midterm? So next, Jenna will put up this chart for our YouTube viewers. I would highly encourage our traditional podcast listeners to take a look at this. What you're going to find is the data set back to 1950, Mark, 1962, 66, 70, 74, 1990, 94, 2002, 2018, and 2022. Of those data sets, the average return in year 3 after a negative midterm year was 24.6%. And the thing that almost scares me to verbalize is that it was higher 100% of the time.
Right. Yeah, it just goes to show you that, there's something to this data set that we've been talking about for the past 6 months or so.
And the compliance side of me has to say, just because it's been right 100% of the time, doesn't even guarantee or imply or mean it's going to be higher this year. I have to say that from my compliance side, but that's the data set.
Yeah. Yeah. And it's just, again, we like to throw this stuff out because this isn't the stuff that you're hearing about in the news.
Absolutely not.
You're hearing that, the banking crisis is going to bring down the economy. Russia-Ukraine war is going to get a lot worse. Inflation's not done yet, but I'd rather look at data than
worry,
headlines.
baby. It's climbing that wall of worry.
That's right.
Talking about that savings, that banking crisis, my next piece plays perfectly right into that comment.
Okay.
All right. So my item number 3 has to do with market bottoms in comparison to how, say, GDP's behaving in the U.S. and underlying corporate earnings. Now, the source of this piece is going to give you a little bit of a chuckle. Okay. The source of this piece is a trader that I follow on Twitter. This is not an exaggeration. The Twitter handle is The Short Bear. Okay. This trader has 60,000 followers. Okay. I don't know this individual personally. I just see he or she post certain things and some of it intrigues me.
Okay.
Okay. So on March 30th, The Short Bear posted this. And Jenna will show this image now for our YouTube viewers. This will be in our show notes. And what it does is it goes back and it shows different time periods comparing, Mark, the S&P 500 when it bottomed and when the economic data such as GDP or earnings, EPS, earnings per share of the S&P 500 when that bottomed. Mm-hmm. And look at some of these different periods of time. And guess what? They're going to correlate to some of the comments you made before in history. Okay? So one of the periods was the Eisenhower recession, and that was back in the late 50s. Next area was the stagflation area of the 70s. There's the savings and loan crisis, right, of the late 80s, early 90s. What you're going to see is a common theme on all of these charts, which is where the market bottoms well before GDP bottoms and corporate earnings bottom. Why am I highlighting this? I want to remind our viewers and listeners that it is normal It is common with history that the market tends to get better before things on Main Street America start to get better. And I was in a client review meeting yesterday with Aaron Kramer. And Aaron Kramer is one of our wealth advisors, and he's been on the podcast before. And a client asked that type of question. Hey, I'm reading the news. My perception is things are going to get worse. They didn't use the term Main Street America like I used in the podcast, but that was what their insinuation was. And Aaron said, well, let's take a look at 2022. He said the economy was just fine last year. Would you agree? And the client said yes. And he goes, well, the market had a pretty bad year because the market led that down. And he goes, just as the market was ahead of the economy getting weak, it's very normal for the market to recover ahead of when the economy bottoms. This puts what he mentioned with some data behind it.
Yeah.
And I wanted to highlight this for listeners because I do think things on Main Street America are going to get worse before they get better. With what the Federal Reserve has done in raising interest rates, in my opinion, will cause sluggishness in the economy in the second half of the year. Wall Street's thinking they're going to cut rates between now and the end of the year. If you look at Fed Fund futures on the Chicago Mercantile Exchange, it's thinking 3 interest rate cuts of 1/4 of a point. That could be debated. And as I said in the podcast, that'll be the debate of the second half of the year. But don't confuse the stock market right now with the economy. Your response?
Yeah, it's a great graphic. I love this graphic. We've talked about it before, and it just pretty obviously shows that the market sniffs out the recovery before GDP earnings or employer payrolls.
Yes, sir.
So I would be with you, and we've been communicating this for the past several months that I think things in the economy are going to get worse before they get better. And it's very possible that we go into a recession this year.
Sure.
But that doesn't mean that just because we're going into a recession or because the economy is struggling now, it doesn't mean that stocks can't move higher, because we've seen those environments before, and that's what you're seeing on these graphs here.
Perfectly put. My last piece will be very quick. This is a reminder about the 2 guiding emotions of investing: fear and greed. And what you're going to find is this is a post from Unusual Whales. It's a Twitter account that I follow that shows kind of large trades that tend to happen in the market. This is a post from April 1st, and it shows a chart that Jenna will put up for our YouTube viewers. It shows Isaac Newton's nightmare back in the 1700s. And what it shows is a chart of a stock called the South Sea stock. And it's from December of 1718 to December of 1721. And what this shows is when Isaac Newton originally made a position in this stock, makes very good money, exits it happy, then all of a sudden, all of his friends start buying it, and they really see some gains. And all of a sudden, FOMO hits in, the fear of missing out. All my friends are making money on this shiny investment idea. I want to be in on this. And what happened? What does the chart tell you, Mark?
Yeah, Newton got in kind of near the top.
And it bankrupted him. Mm-hmm. This was the quote from Isaac Newton afterwards. Quote, "I can calculate the movement of stars, but not the madness of men." End quote. Newton apparently said after he lost his fortune.
Yeah, it's interesting, and we've seen this, time and time again. We saw it probably most recently with crypto, with the meteoric rise and subsequent meteoric fall. Mm-hmm. We've seen this with the pot stocks, the marijuana stocks.
Keep going. You got oil stocks were hot for a while there. There's just the hot trend that's always around. There's always a hot trend.
Yeah, and typically if, you're hearing already about how much money people have made on something,
the easy money's been made.
The easy money's
generally
been made.
speaking.
And that's what happened in the tech blow up in the early 2000s, right? It's like people couldn't lose money buying anything that ended with .com, right? And then, as people were learning this and piling into it, wasn't too long thereafter where it had a pretty substantial fall.
Gravity took effect, and guess what? Earnings mattered.
All right, so usually when you hear about this stuff, it's already too late. And again, talked about this several times before, but typically when people are boasting or bragging about how much money that they've made in something, it's like you said, the easy money's been made, and just because someone else has made money in something doesn't mean that you're going to make money in something. Everyone's risk tolerances are different. And the last piece of this is no one's going to talk about their losses.
Boom. And so you perfectly put it. So in the future, I know these trends will hem and haw. In the next couple of years, when the next kind of hot trend comes and it's the water cooler talk about, their friends at work, I'm going to sit there and say, hey, remember episode number 195 of our podcast? Go back to the end. I had a reference point about, the hot investment theme that's in vogue. Those things come and go. Be careful.
Yeah, absolutely.
All right.
Absolutely. Anything else before we wrap up for the week?
Jobs report tomorrow is coming out. It's going to be very key. We are seeing initial jobless claims rise, and so it wouldn't surprise me if those numbers come in softer. The expectation I saw on Bloomberg was somewhere in the avenue of 300,000. I think it could be less. I just think that you're going to see that trend lower with what the Fed's done. And then we have inflation data next week on the 12th at 8:30 a.m. We have CPI.
Mm-hmm. And then not too far away from earnings season.
Correct, sir. Banks are at the end of next week. Does that sound about right? Or the beginning of the following?
Yeah, I think so.
Okay.
So banks will kick it off like they always do. But other than that, hope everyone has a great long weekend. Happy Easter to everybody. And
check out the Masters, everyone.
Yeah. We'll be back with you next week for episode 196.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.